Charandeep Singh, founder and managing director of Girik, and his partner Varun Daga. They both join us live. And gentlemen, good morning. Thank you for joining us. Last 1 year, it was all about COVID, which perhaps was the reason why we did not meet in our studio. Today, I was hoping that we will welcome you to our studio.
Nico, good morning. You gotta invite us first. So you invite us and we'll come next time.
Okay, open invitation extended on television screen. Next time, let's have coffee in the studio.
Of course.
Is there an open invitation now for long-term investors to start buying? Do you think markets have reached those levels?
Yeah, I think so. I mean, we've held this view for a while. Caveat, we are perma bulls, I must tell you, because we've been doing this for 13 years. And, excuse me, there have been about 6 instances of any sort of semblance of any reasonable fall in the Nifty of say 10% or more. This is the 7th instance in 13 years where you've had a large fall. So, I mean, investors shouldn't be fretting or sweating it because, yes, you have had damage in the broader markets, but that's always expected if the Nifty falls 10%. So I think investors should really be allocating money. And if this fall continues, I think it's an even better opportunity.
Okay. Varun, I'm going to start with a very big picture question before we get into specifics of your fund and what your sectoral allocations are. As we look at the scenario where macro tailwinds of low interest rate and low commodity prices, which have become a complete headwind now, and that will have an impact on the future returns. For a 2 to 3 year, or let's say for a 3 to 5 year basis, from here, if the starting point is today, what to your mind could be the return expectation range?
So, good question, Nikunj. And actually, we did that exercise with our own fund. And I think every time the market falls 10 to 15%, it opens up a lot of opportunities. And I think the key question here is going to be that where do you allocate money? So it's going to be a very, very stock pickers market. And I think if that done well, one can easily make 10, maybe 12 to 18% range. But it will be it'll completely rely on how you pick stocks. So it's going to be a very, very stock pickers market.
Okay, morning, gentlemen. Avan as well joining into the discussion, and let's get sector specific as well. And just looking at the kind of exposure that you guys have, there seems to be a thrust, of course, towards the financial space, refineries, and then financial services and NBFCs. I'm going to pick out the NBFCs and financial services because that was a discussion that we were having earlier this morning as well. That in previous market cycles, you did have IT, which took leadership. Do you think that it's now time for the banks to take the front seat? And in having said that, is it across the board? That question is for you, Charandeep.
Yeah, sure. See, with banks too, one has to be quite selective. I think we do think banks should do reasonably well in this cycle. Of course, they've taken a hit. See, the reason they've taken a hit is, largely because it's a very owned sector. A lot of the India allocation lies in the financial services companies. These are large companies with large free floats. So naturally, they're prone to getting a lot of redemption. For these sectors to go out, the entire sector to go out to make a new high and provide the kind of returns it has in the past, over the last decade, will require sustained inflows. So whether that happens or not, we don't know. But I can tell you that one has to, again, be picky over here and stick with the banks where you feel there is some semblance of under ownership. And you can, banks or NBFCs rather, where maybe there is a semblance of under ownership, or where the earnings can really surprise investors. So something, a combination of those things, one should make their allocation. But, a broad-based allocation to financial services may not be sensible. So it's wiser to be the picker rather than the allocator.
Wiser to be the picker than the allocator. Varun, I'm curious because there is a holding in the portfolio of Bharti Airtel, and the street seems to be rather unnerved on Adani's entry into the 5G spectrum auction space. and that has sent the stock price of Bharti Airtel under a bit of pressure in yesterday's trading session. That could lead to a potential round of disruption in the market with now Adani Group's entry. Are you worried?
It's too early to say, right? Because it's just the news just flashed yesterday, and these days it's the stocks react very fast. But I don't think fundamentals have really changed. So we have to wait and watch. We have to understand what businesses can they disrupt of the incumbents, and market always gives you time to react. It's no point just uh, you know reacting to a news. One needs to understand, get into the nitty gritties of things, and then take a call. So I would say it's still too early, and then we'll have to wait and watch for now. But am I worried? Not really, but we'll have to see how it goes, and we'll take the appropriate actions if required.
Good morning, gentlemen. This is Nantara joining in. What I've done is I've compared your holdings and the stocks you're holding with May versus the latest presentation that we have. And in fact, I see you've increased your holding when it comes to Bharti Airtel. But what also really struck out for me was the way you guys have reacted when it comes to IT services. It seems like you have sold a lot of IT in the last couple of weeks.
Yeah, so a good observation. So we've been, after the whole meltdown in the US, we took cues from that. And, IT was one of the leaders of the past rally, especially in the last 2.5 years. And I think a lot of these companies already had the best times in terms of earnings. A lot of re-rating happened. It had also become very, very over-owned. It had become the darlings of the market. So we really we thought that it's probably coming to the end. Still, these are great companies. Earnings will still be decent, but we've downgraded it significantly because we feel that the leadership which was there in the last 2 years may not sustain for the coming years.
So just to let our viewers know, IT in May for Girik Capital, the holding was about 12.5%. It's now down to about 5%. So that's the kind of change in pecking order we've seen from Girik Capital when it comes to IT. Varun, coming to you, I've also seen a change when it comes to Reliance. Not so much, but you have sold RIL. Likely to continue to do that?
We just balanced it. It was a large position for us, so we just balanced it. This is, we just took a call because it had done well for us. We've been holding this stock for quite some time. So, but we are still, we're still confident about the story, and no, view has not changed at all.
Sandeep, for what is standing out for me is the following: Blue Dart, great company, expensive stock. ABP, phenomenal engineering skill, but expensive. Hitachi, I don't know the P multiple there, so I don't want to comment on that. And Gujarat Fluorochemical is also not cheap. Now, the general view in the market is that go back towards value. The general view in the market is that interest rates will move higher and the high P stocks will get crushed. But your holdings are not reflecting that. It's a differentiated thought. Let's understand why. Oops. Bit of an Harry Potter. Both have gone. Happens. Rain, rain. It's raining in Mumbai, gentlemen. And when it rains in Bombay, not only the roads they get clogged, network connections they also get blocked. So it's just blame it on rain. Trust me, it's rain, nothing else. I can assure you that Charandeep, whenever he comes back, he would love to answer that question, that why he's bought into Blue Dart. Okay, Varun's back. I think we've lost Charandeep there, bit of an Harry Potter moment there. He's gone, he's not come back. Varun, you're back. Let's understand, you bought into Blue Dart, you bought into ABB. Now, these are not the classic value stocks.
Right. No, absolutely. If you look at the P multiples, they look elevated. But I think, one have to go beyond the P multiples here, both in ABB and Blue Dart. I don't want to go to the specifics of it, but I think the general thesis in let's say like an ABB, which is capital goods, we've not seen a cycle, the capex cycle for such a long time. I think the last time the India was doing capex in maybe in 2009, 10, 11. After that, we've seen a lull for almost 11, 12 years. So, there's been a clear shift of, capex cycle being coming back. And whoever we are speaking to, a lot of managements, they are all gearing up for a capex cycle, so which could be very interesting in terms of the earnings acceleration what we could see over the next 3 to 5 years. So I think we like that theme. Of course, ABB being a leader, we've backed it, but I think the broader theme is that we feel that the capex cycle is coming back. Industrials and capital goods stocks may do well. So I think the point of ABB and Hitachi being in our portfolio, I think it's really the capex theme. On the other hand, Blue Dart, it's more of a company specific uh, play. We've seen in the last many years, because of many of the online guys and companies like delivery and even other delivery guys have really taken the pricing down substantially for many of these players. But I think what's happening in the whole logistics sector is that the pricing is coming back, and which is very interesting for a company and a leader like Blue Dart, because when that happens, you're obviously playing at a level playing field. And adding to that is the growth has come back, and there's been a lot of growth on ground, and there's been a lot of demand on ground. So I think some of these companies could really surprise over next 3 to 5 years.
Sandeep is not back, right? Varun is not
Yes,
with you in the office?
he's back. He's back.
Okay.
Hi,
Sandeep,
sorry.
bit of
I
no,
think
it's
troubles with the monsoon. Yeah.
yes. Everything that goes wrong in Bombay during monsoon, we just blame it on monsoon. But trust me, it's true. Our viewers will not understand. They got to be here in Bombay during monsoon to understand that what happens to the city.
Which is why you need to call us to your office.
Exactly. Now you understood what was the secret motive by inviting you. We would have not had this audio problem. Sandeep, there is one surprise for me. And that surprise is you've not included your good old favorite HDFC Bank after 3 years of underperformance.
I think, I made that point. I think, the question was asked just a few moments ago before I logged off as to which financials, where the financials will do well. Look, it'll do well. I think there's no harm. But, will it meet our return threshold is our concern. There could be banks playing catch up with HDFC Bank. And there could be banks that could, or we feel also could surprise, more than an HDFC Bank, because the expectations set could change in those banks or NBFCs. So like I said, it's better to be a selector or a picker rather than an allocator here. So I think this one's about return threshold. It's nothing else. It's about how much money you can make over the next 3-4 years. Relative IRR. That's the only reason we don't have it as of now.
Charandeep, what about, the big data game, digitization, names like IndiaMart? I don't see real traces of that currently. Is there any particular rationale? Is the view overall changing now? Are there concerns emerging?
I think Varun made this point about IT in general. I don't think there's any issue there. I mean, I'm sure that theme is very secular. But, then for us, picking and allocating in our portfolio becomes about various factors. You have to think about where you're going to make the money. So great companies may not prove to be great stocks over a 3 to 5 year period. They could go into long consolidations after massive rallies and moves. And we have to build that into our return profile. So I think that our allocation or our stock selection decision is really driven by where we feel we're going to make the money. And sometimes headline valuation may not be the best indicator. It's a combination of various factors, that we look at, not just the headline valuation or if the earnings trend is going to be really secular. Sometimes you have to think of the surprise, that element that could come in, through to the street, which could result in more money flow into those stocks, and thus push the price up, beyond what normal expectation is.
Element, if I may, just to understand better, Charandeep, when it comes to NTPC, because in the current interest rate environment, that can't quite bode well. There's no ESG presence. So what's the rationale for NTPC in the portfolio?
Rather than really getting into the depths of a stock, I would tell you that, what we found when we looked at the power sector is that, the only real way to play it was this. It was up on our screeners. The earnings growth was looking interesting. It looked like it was coming out of a long earnings and capex cycle. And, if you generally go out and look at a company like this and you look at the earnings expectation that the street models in, it's 6, 8, 9%. We're hoping we get better. And, these things are trading at very inexpensive valuations from a historical perspective. But after, when you look at something like interest rates, these are probably the least sensitive to interest rates, because they have access to funding relative to any other power utility in the country. They have access to the cheapest sources of funding because of their Government of India rating. Today to put up a solar power plant where the bidding is cutthroat, where the IRRs are low, if you can't get funding at these rates, you can't put up a power plant unless someone's really throwing capital at you. So I think that's a big advantage rather than a disadvantage in a rising rate environment, because your competition won't be able to attract the kind of capital, at least debt capital, that you can.
One last question before we let you go. The last time we had you folks, and any one of you which wants to take it, I still remember you said it's an avoid on Zomato. I don't know if you knew what was going to happen with the capital allocation plans then, but since then, of course, you've seen the Zomato stock come under so much pressure, and you folks also had a buy on Trent. Trent still remains fashionable in the stock markets. Are you still bullish?
Sorry, your question was on Zomato or Trent? I didn't quite hear the entire question. It was
Trent.
Yeah, so, great story. I mean, these are brilliant stories from a very long-term perspective. We like it, but remember, there's competition for the top 20 or 25 stocks in our portfolio. So we do make tweaks and turns here and there. And, sometimes you'll find a stock entering our portfolio and exiting our portfolio. It's largely based, like I said, on the selection decision, where we feel we can make maximum money over the shortest period of time, and that being 3 to 5 years on average. But remember, again, the point I'd like to make here, when the market goes through such a vast churn, when there is so much money going out of markets from FIIs, there's leadership changing, new sectors emerging, it'll always throw up a new set of opportunities, which is what we are seeing right now. So if we have to limit the number of stocks we own, we'll have to sell something to buy something that meets our return profile.
So, Varun, I'm going to wrap up the discussion with one simple, thought for our viewers. COVID changed the way investing was done. Interest rates came down, inflation started moving higher. This inflation crisis has also changed the way how investing would be done for next 3 to 5 years. So looking at your existing portfolio, which is in public domain, we'll put it out also. Do you think this holds true for next 2 to 3 years, where we will see minimal changes? Have you built this portfolio with the view that it captures all the macro challenges and also will be a beneficiary of what is happening in the world?
Nikunj, I'll tell you one thing about macro. We least understand macro. And, I'll tell you what I find very funny when you look at macro. For us, these words really don't matter because we go bottom up and not top down. We're not top down experts. I must tell you what I've seen is the entire rhetoric, and we were having a bit of a snigger about this at our Monday morning meeting, where the entire rhetoric shifted to inflation. So from inflation, which has been the talk since this war broke out in the West, this entire talk of hyperinflation. And yes, there is inflation in the world. It's not gone away. But that talk has slowly changed into a recession talk, So you could have, so is it inflation or is it recession? So, I find that really amusing how, the headlines change so quickly. I think, yes, the bottom line is that markets do roll over. There are corrections such as these 10% odd corrections every few years, every couple of years, where you get a chance to go pick the stock that you want. And yes, I'll take your point that the investing environment does change whenever there is such a churn in the markets. It gives you a chance to look at new sectors. And, there is a lot of newness in the markets. There are new sectors coming up on our screeners. And it's very different from what worked over the last 10 years. Just like an IT came up in 2020 or a metals came up in 2020-21, there are new sectors emerging on our screeners. And I think it's to your point that, whether it's inflation or recession, I don't know. But, certainly the churn in the markets is resulting in sort of new leadership and new names coming up, which we're looking at. And that'll obviously get reflected in our portfolios or has already started getting reflected in our portfolios.